Good afternoon, everybody. Welcome to today's session with Hutton Henry of Beyond. Really looking forward to hearing what Hutton has to say on such an incredibly important issue if you're looking to raise investment, the due diligence, everything that happens.
We can get started. So maybe over to you.
I'm just going to mute those microphones to make sure that there's no background noise is disturbing us. But thank you all for joining me. We've still got a few joining the room, but we'll crack on. So look, if we could have as many of you keeping your videos on for today's session as possible, that would be awesome. It makes it so much more engaging for us and for the speaker today to actually see your faces and know that it's not just a room full of AI bots that have joined the session, but it's actually real human people here as well. So that's great. Thank you very much for doing that. So just a quick rundown of the format for today. I'm gonna give a quick introduction to Robot Mascot, and then we're gonna hand over to our speaker, and then at the right time we'll jump into some Q&A at the end. So keep an eye out on anything that you wanna ask, any questions you wanna have. Take a note, and we'll come to an interactive kind of Q&A at the end. And the more people that ask questions, the more engaging that can be. So please make sure you get involved at the end so that we have a really good and successful and engaging session today. So look, without further ado, I'll jump straight into it. Quick introduction to us at Robot Mascot for those that are maybe new to the community. I'm James Church. I'm the author of a best-selling book called Investable Entrepreneur. I'm also the co-founder here at Robot Mascot, and you'll meet the founder very soon. Robot Mascot, we're essentially an investment readiness agency. We specialize in creating investment materials to help you convince investors and raise those pre-seed, seed, and Series A funding rounds. We work with startups, we work with scale-ups, we work with SMEs that have been around for 5-10 years and need working capital to take advantage of new opportunities. But ultimately, we're helping you raise those first few rounds of funding so you can start up or so you can scale up. We've supported more than 3,000 founders to date to do this. We've worked with founders all over the world to raise investment, the UK, of course, but also Europe, the Middle East, USA, Asia, Africa, Australia, literally all over the world. And when our clients apply our leading methodology, they become 40 times more likely to secure funding. They've raised more than 220 million to date, and we've won global and national awards for our pioneering approach. Now, what we really want to see at Robot Mascot, the reason we do this, the reason we put on sessions like this is we want to see great ideas and innovations flourish. And we get so frustrated at seeing so many incredible ideas fail to have the impact that they want to have on the world because they can't convince investors to back them and their innovation. So that's the problem we're here to solve through not only the work we do, but the sessions we put on to support you like this today. So very quickly, for those of you that haven't already been on one, I'd love to invite you to one of my fundraising strategy sessions. Every week I do a 90-minute group session where we go through a funding methodology to help you prepare for investment and make sure you have everything you need to succeed. We'll delve inside the mind of investors and look at what you need to have in place to secure your funding round. So if you want to do that, I'm going to put a link into the chat very shortly so you can book into one of those sessions if you haven't already been on one. So without further ado, it's time for me to hand over to my business partner, Nick, the founder of Robot Mascot, to give a quick introduction to our speaker today. Nick, over to you.
Thank you for that, James. That made us sound pretty good, really. Thanks for that. So yeah, I just really wanted to say that we're really, really fortunate at Robot Mascot because we get to work with so many inspiring founders that are taking leaps into the unknown. And taking those leaps can be pretty daunting and sometimes pretty lonely too. So that's why we like to bring you these sessions, bring these sessions to your home, to your office, wherever you're working from, to support you on your journey and to give you access to great people like Hutton that can help you with whatever you need help with, get you there much quicker. So I was really pleased when Hutton said that he'd help us. He's been a good colleague and ally of ours for some time. When he said he'd join us on this session, because he's got loads of experience to share. So, and today Hutton's going to be covering what you need to do once you've prepared for investment and attracted investors. So I hope you get lots out of today's session, and please do feel free to be really vocal as well and ask lots of questions at the end. And now I'd like to introduce you to Hutton Henry, the founder of Beyond.
Hi, thank you, Nick. Thanks for the introduction and for having me here. As Nick has said, I think we've known each other since around 2017, 2018, and we work in quite similar circles. I'm going to make sure my animation works on this. I put a load of time into it for it. So here we go, here's my animation. And this session, so the first thing I'm going to promise you is it's proper interactive. I'd really like you to be involved in this, and so that we can help look at each other's results. I will also promise you that regardless of what stage of business you're in, I have noticed that these things are quite applicable to any stage. And I'll give you a bit of my history and you'll see why I can sort of make those sort of claims. But more about you, if you are investor ready and you've got your letter of intent, what on earth is going to happen and how can we help you prepare for that? So enough of my animation now. Very quickly about me, my background. So I worked out the other day, I've actually worked in tech M&A for 30 years now. First job was working for Ford when we bought Jaguar, working for HP when they bought Compaq, and now working for much smaller businesses, and I absolutely love it. I work on, I have a team of 10 of us, and we look at between 5 and 7 firms a month for investment or buyout. I'm also a qualified coach. I've worked with more than 400 people, and I totally believe in people first, and the fact that it's the people that make these investments work. Of course, that's common sense. One really important thing for you to understand, I'm not an investment banker and I'm not providing financial advice. There is space in this industry for lots of people like Robot Mascot and my business and investment banks. I'm going to just give you a little bit of the secrets in the area that I'm in. So if we take, you probably understand the term investor readiness. I don't focus on that. I'd say that Robot Mascot excel in that. And I've actually jumped on their courses so I could understand it from their perspective. But there is this sort of gap between the letter of intent, due diligence, and signing a deal. And I've been doing this work for over 10 years. And a few years ago, it suddenly clicked. There's so many patterns that regardless if it's a services business or a SaaS business, chocolate making company, there are some common problems that I've seen, and I want to share those with the world. I don't make my money from founders or investment or from management teams. I work purely for investors. And I have spoken to the investment community and said, would you mind if I share this? Because I'm giving away a lot of the red flags, or amber ones, at least in due diligence. And they've said they're very happy because it helps the investment community see it as a good thing, because it means more polished companies are coming their way. So the two things I would say is that buyer or investor confidence throughout the transition through that period of due diligence is really important to keep up, and doing and working on so many deals to watch that confidence go up and down on various business deals, and it's interesting to see. And so, as I say, there with the right approach, you can present your best to investors. Very quickly, just so you understand what that process would look like if you were working with us, we're one of many firms that would assess your firm, your company. We look at the technology, and so we get a maximum really of 2 weeks to understand a business top to bottom, but really a full report comes out within 3 to 6 weeks, and that company could have been going for 20 years, right? And we have to understand everything about it and try and give our informed opinion. I like to say that we're paid for very high and very opinionated statements, but all backed with data. We're trying to help both sides get the best out of the deal. And on the right hand side, you can see the areas that we look at within those 2 weeks. Now, that same thing, that same structure works with a 2-person startup, or we recently did a deal over 1 billion, and it would be exactly the same sort of structure and things. And it's a great job But I just wanted you to know how much of this time is taking. If you were ever to go through this, and maybe you've been through it before, there is a very structured approach, but it's done in a very condensed way. So the reason why I showed you that structure and the process is I want to show you what I sell to investors. So on the early stage firms, this is one of my slides. And I would say to Miss or Mrs. Investor, if you work with us, we'll probably find on average 250K of additional spend. Things that the company is not spending today that you're going to have to fork out for. And because investors don't only focus on risk, they want to look at opportunity. We say that between my team, we find, on average 10 ideas, the silly brainstorming things based on market experience and working with the target. So I'd like you to see that left-hand number, 250K, EBITDA multiples have changed, but on average, we times that by 10, and that potentially is how much will come off your deal. So 2.5 million if we find all of those items. So my job really, and you'll find at the end of this session, by the way, I provide even more information on all these different areas that you can polish your business. So what's holding founders and and management teams back? It's that top line there, really, is every single company I work with, they just don't know what good looks like. Now, if they've been through diligence and they've sold their business or got investment before, they're more likely to be well prepared. They're probably not my audience anyway for this, but I want you to know what good looks like so that you can work towards it. Because if you don't know what good looks like and you don't fully understand what the investor is seeking, we end up turning up not prepared. And I know very much in Nick and James's material, they very much talk around the differences in language between the investment team and the founder, or the sell side, if you like. And usually the founder wants to show the art of the possible, and the investor is looking for risk. And somehow you need to present both. And some of my material completely connects with Nick and James's. The last thing before we jump into the interaction piece is my business has 20 maxims, and this is the number one that my whole team works upon, and I like to share it with everyone else because we are tech oriented, so we look at the tech and the business. But what I'm trying to say with this statement of, and I guess the word Trump is a bit controversial at the moment, so please excuse that, but the term is like market trumps tech. And what I'm trying to say there is, with the 5 to 7 jobs that turn up on my desk every month, first thing I look at is the market sheet. Can I find a big needy market? Have you articulated that well? Because that is the most exciting type of business. It doesn't matter what tech or, actually some of the most successful deals I've seen are in the most boring areas ever, but the market is huge and there's governance, there's lots of things behind it. So I think that's the last bit of me talking at you. What I'd like you to do, if possible, either on your computer or on your phone, I've put a QR code there. And if you can actually either use, I can put this in the chat if you like. 1 second. Yeah, there's the scorecard. Can everyone get that? And what I'm going to do now is I'm just going to quickly run through this so I don't take up too much time. 1 second. Is everyone able to get to that scorecard?
Yes.
Yeah, great, thank you. All right, so you know how to use the scorecard. I'm literally going to say this is private to this group or web course. Not heard that term before, which I think is brilliant. We will get instant results as a group, and I can guarantee you, I mean, there is some value in this, and it does lead to the other assets that I will share. But the thing that surprised me, the last time I did this was with a team of company, a whole room of companies where their revenue was 10 million plus. They're all kind of there, and a lot of them didn't have these things in place. So that told me that was well worth it then. So if you can just fill in your details, and I'll just very quickly whiz through these because I'd rather talk through your results and any questions you have. So yes, no, unsure, very quickly. This question here is whether you've got documentation, but the key thing is regularly updated and accessible. So yes, and this is a really big thing. Once you're through the deal, people like me are looking for evidence that you're creating value. It's not good enough that you have a SaaS platform that makes money. I want to know that you've put in some kind of calculations, that you know how much money you're putting into a feature or a service, and the effort you're putting in and the value created by your decisions, innovations, or any strategic moves. So and I've seen people do it in Notion, just like a little list, anything like that. Most people don't do it. And if you could be as truthful as possible, it'd be really helpful, by the way. Do you have a detailed, up-to-date financial model? If you work with Robot Mascot, you definitely have one of those. I was really surprised at that group of the 10 million plus businesses, 25% of them didn't have a financial model. In your historical decision-making process. So what I'm saying here is, shall I enter that, admit that person? Yeah. Here is really, these are pretty basic things, meeting minutes, all those sort of things, but do you have them to hand? Because if you're working with me for 2 weeks and other teams, you've got to get these really out the door as soon as you can, and you've got to run a business as well. I think everyone will have one of those. And this is one of those things that we definitely connect with the Robot Mascot work, is making sure that your pitch is both compelling and realistic. So you're pitching the art of the possible, and you're also trying to pitch what could go wrong, right? And so the easiest ways of doing that in your pitch deck is a SWOT, some way of showing that you are realistic around your business. And okay, yeah. And again, back to value. Seeing me come back to this all the time. When I look through people's documents, I don't really care if they're running on Azure, AWS. I want to know the strategic mind of that team. I do have to care if they're on Azure and AWS, by the way. But the things I'm really looking for is the way you record the value. Because once you get the money, this is the really important thing, is it doesn't matter what stage of growth you're at. I can pretty much guarantee each time you raise, the speed gets higher and the governance goes up at the same time. So you have to report even more, and you want faster results. And another one, this is a flaw in so many companies we look at, is the business processes at the back end. So we put all our money into our services and SaaS, but at the back end, we haven't got the order to cash systems right. They're not automated and they're not scalable. I'll put a no for once. And a very typical DD question, if you gained 100% more customers tomorrow, would your business or product handle it without major issues? Have you got any IP? I would think, being on this group, I think everyone would. So I think that's pretty simple. And then go back to that order to cash piece. Not only have we got the automation and the aspects around that, but do you have inefficiencies that you know of in your order to cash or revenue generation piece? And another thing, I would say 80% of companies that come on our desk don't have this. It's just a cybersecurity assessment. A lot more people are going for Cyber Essentials Plus, all those sort of things. These are small little indicators of how well you're looking after the business. You're always going to look after the product, the team, the customers, but I'm looking for different signals of how you're going to use money. And just out of interest, do you feel left behind, or are you in front of artificial intelligence? So I'm not sure we really need it for this one, but how long has your company been operational? Have you won any awards? Have you been featured by the media? We're getting quite there. This is a key thing. I think younger people tend to be really good for the really up for this now, is the psychometric profiling when you're hiring your team. What are you going to do? What systems do you have in place today that will convince us that, you know, if you get a £2 million deal, you're going to spend again quite well? Do you have a board and or shareholders? And does your headcount grow? This is a really indicative DD question from us and most DD providers. You know, we just want to know how scalable your business is. It's a simple, slightly opaque question, but we're quite interested to see how scalable your company is. And you know, are you going to have to? We looked at a MarTech business, looked fantastic, but to get to the growth area, they were about 50 people today, 2-year fantastic market, but they would have to hire 300 people to grow. It's not investable, and that got past investment readiness, past the investor 6 months of courting, and then you're in with people like us, and we're like, well, yeah, you're gonna have to do something about that business. In fact, in that case, we had to re-platform, spend a few £1 million. Is there, and it's a very common one, is there ongoing friction within your leadership team? Because I can guarantee you, if you do have that, we will all see it through the process. The investors will see it, we will see it, we will all talk about it. And it's like, well, where is that person? Why aren't things being done? So once again, being a founder as well, I'd much rather you fix this than an external person. And I will also say it is incredibly not exciting. It's incredibly surprising how many deals go through because the management team haven't been able to sort themselves out. So I often see companies where the two partners are sick of trying to run the dynamic, and they think, well, if we bring it to private equity, we will get more governance. And so if only you could do that yourselves, it would be much cheaper. So it's not in mind. But if you have done M&A, have you integrated teams? Okay. And do you have structured processes for hiring? And hopefully some of you have done this. I'll see what's happened. Great. Okay, so we've got 28 or so. Just let that come through. So I'm going to quickly, so I'm going to spend sort of 10 minutes very quickly on spot answers on here. But you can probably see quite a high level of regularly updated thing. I'll be upfront. I would say, and we built a platform for this. You know, we take everyone's documents, and we can often see there's no timeline. All the documents have been done in the last month, because it's like, oh my gosh, I'm excited. I'm going to get my raise. But we can see they haven't been writing documents all the way through, and often they get other people to document. So really great to see that you have a much higher level than I typically see. I think the ones around value, this one here, it's I have a really good case study for you. I've been coaching a firm that didn't get through diligence, and they were very disappointed. 15 years of work going through, and they were selling their business. And it was basically because a lot of the things in this scorecard weren't done. So our confidence went from here to really low over the time. And in that situation, the CTO was quite resistant about documenting, but now he's been brilliant. I mean, he's literally putting up very interactive updates, and they're quite good. So very good on the well, I'm not surprised, as I said, about the financial model, especially if you're on this group. I think we're much hungrier, where the more established businesses sometimes lose this for some reason. And by the way, if you've got questions, please let me know, and we will grab them at the end. The business value prop is realistic. That's good, and compelling and realistic. Now, one of the assets at the end will, help you go through that as well. But that's a really good score for 25, 28 people. And it's a shame I can't really ask questions, but the main thing here on the return on investment, I would say a lot of companies, even the ones that are doing 10, 20 million, a lot more, are very poor at recording the return on investment. And I'm finding now as well, because we are tech, we're getting calls from the investors to look at value creation from a product perspective, but also from an engineering perspective. So from a product perspective, if I put this feature in, I'm going to get 3 times this. And from an engineering perspective, I've got this number of engineers and I'm getting this amount of value out. Lots of spreadsheet work there, kind of thing Robot Mascot love. So that's the pieces there. So again, good on the historical decision-making process. And it is higher than I would tend to see in my job. And again, that's interesting because I think that connects to the value piece that you're seeing all the way through. So there's some work to be done there. And that's with the order to cash piece. So just as a reminder, just making sure that we can automatically get our money. Sometimes it can be quite easy. You just got a subscription on a SaaS page. Other times it's a very convoluted process. And it's good to know. I even encountered a company 6 months ago who was putting they were printing every single record and putting them in cupboards all the way through, and so the whole paper trail was there and they didn't have to do it. So okay, and with this one, with having to increase the headcount now, you know, I mean, or actually no, it's the other way around, sorry. So make it so the business, 75% of businesses on this call could handle increased demand without an issue, which is really good. Again, I'm not surprised there's a lot of IP in this group. I'm trying not to go through these in sort of some thing. That's a great one to see. Inefficiencies from order to cash. So can you see how if we just took us as a very small cohort, it's one of the biggest things that investors will bring is that governance on top of these processes. And it's one thing I absolutely, it's my absolute ethos to help fellow founders find these problems and address it before they go to market. Obviously, it will be different for every single company here. The awards things, I mean, that's just a nice to have. Profiling, I think is interesting. But I am quite biased, so I think I'll probably keep my bias out of this. I think, to be fair with hiring, when we're looking at management teams, when we're assessing entire companies, we tend to only look at the senior leadership team anyway, but we will look into the whole hiring process, how it works and how effective it is. Especially, I think the market has changed, so the hires are a bit easier than they have been. There's more probably supply than there is demand now, but we still want to know you're not just hiring people like yourselves. Good to see you've got a lot of you with boards and shareholders. That's really good to see. I don't think, I mean, it's a nice to have in this questionnaire, but it's not. It's just a natural progression of your business and where you want to be. The headcount one, this was the one that I was talking about earlier. So without knowing your individual business, I can't say whether that's good or bad. I can give you 2 examples where we've had to reject 2 or 3 businesses where they've pushed in AI as the core value prop. And then when we look at that value prop and we go through the process, it's basically humans enabled by AI. So as the company had massive growth plans, then the team gets bigger. And I think just be prepared for that question. It's a really simple, obvious thing to look at, but have a good answer. And in some cases, human action is an important thing. So my other suggestion in here is, if you do have high headcount requirements, you need to know your numbers. And what I mean by that is, how much effort is automation or AI managing to cover? So is it covering 80% of the journey or 20%? Just, before you walk in, because it's one of the first things that investors and us are going to ask. And if we're not clear, we may ask you to go back to the drawing board. That happens quite often. And see, I spend a bit more time on that one. Brilliant. There's only a little bit of friction. So whoever the 14% are, as I say, there are quite a few deals where we will notice the friction during the assessments, and that will get reported back to the investors, but we will talk to the target companies as well. We're wanting to help them understand, where, what can we do to make things better. And I think, if you remember, I was saying earlier that every single deal, the money gets bigger, speed goes up, and governance goes up. Now, what I tend to find is really the question behind that is this team today the right team to go on the next journey? And that's a really tough one if you're a founder, because you've probably got people who are in there from the beginning. But we do need to form of not housekeeping, but we must get rid of the friction, because it will kill us. And I often, by the way, get involved post deal, and 6 months down the line, we haven't made the progress that we promised the investors. And so the job there is to try and look at the entire business again, but also trying to understand why people are not delivering as per plan. And you can imagine it's the normal things, right? Engagement, differences in opinions. None of those things suddenly go because an investor comes on board. I think probably not for this group, but it's interesting to see what people have done with M&A, and 25% have done it successfully. And the hiring, again, it's good to see a high level here. So I'm gonna open it up to you in case you have any questions at this time before I go back to the other material.
I'm not sure if right now is the right time. Hi, I'm Martina. Sorry. I was wondering about the 250K additional spend. What would be examples of what that money would be spent on?
Yeah, that's good. So some of them will be in the areas that we've just talked about. So just basic hygiene of like security measures, that type of thing.
Remediate issues you've uncovered.
Yes, yeah, okay. Absolutely.
Okay, thank you.
That made it shorter for me. Thank you, Martina. So that's
cool.
cool.
So we've got question in the chat here from Alan. Says, is there a ratio of the headcount to customer base that's important? Which is an interesting way to look at. I've heard revenue or ARR to headcount, but not customer base.
No, it's definitely not something we consider, Alan. I think, and I'm going to be that really awkward person and say it's a depends answer, because we need to look at how that business was pitched to us in the first place. If it was pitched to us as a services company, then headcount's really important. Where if it's automation, AI, SaaS, then it's important in a different way. Alan, is there anything that came to mind while you asked that question? Or...
Yeah, it was just because of the question in the survey about does your headcount grow as your customer base increases? So I was just wondering whether there's sort of an ideal ratio, or is it just to have a system where they're not one-to-one, basically?
Yeah, that's in relation to actually a question I wanted to ask Hutton, is because we see a lot founders, because I think whether it's in relation to the actual physical customer base or in terms of the size of the business, like revenues generated or annual recurring revenue created, there's what we see anyway is a lot of founders with, they've got this $1 billion SaaS company idea, and their forecasts are showing that they have their tech team of 5 to 10 people and the founder, and then their forecasts kind of scale up this revenue dramatically, and there's no sense of sort of scaling up much of a team, maybe a couple of extra hires, and you've got a team of 12 people running a multi-million-dollar company. Now, when we look at SaaS kind of metrics, and there's different metrics for all kinds of sectors, but like the average revenue per employee kind of across the board in the UK might be like 150k revenue for every member of employee. With a SaaS company, you might be looking to do 300k ARR per employee as a benchmark, and a lot of VCs I've spoken to have kind of seen that as kind of optimal. Do you look at that, or is there any kind of insights you can give to that? Because you mentioned like hundreds of staff, but if you're going to be planning and forecasting a 50 million ARR SaaS platform, presumably you still need to make sure that that's realistic and that you've got one member of staff for every 300 to 500k of ARR.
Yeah, definitely. And obviously you have that customer service tranche as well, which just gets really big, doesn't it? So how good is your product based on how big that team goes on? So usually by the time the team comes to us, they have a financial projection. So we're just analyzing how that looks. And you're right, James, that we will, it's just an immediate thing, or that seems like an expensive revenue to head that type of thing. So there isn't an idea.
Two warning flags, like one, you haven't got enough staff for the amount of revenue you're forecasting, perhaps, or you've got too many staff, therefore you're not scalable enough, and therefore not an attractive offer. And there's this sweet spot in the middle for different types of companies. And I guess if you're well beyond that, let's say, a typical VC might be looking for 300 to 400 ARR per member of staff, and you're projecting 600. And like eBay, for example, they get 800k for every member of staff. Amazon get 300. So there's definitely differences for different types of businesses. But I guess what you'd want to see is what's the rationale and the kind of systems and processes and automation in the background that enables you to deliver something outside of what is quote unquote normal or expected and it comes back to kind of internal efficiencies and that kind of thing that need to drive that. Is that right?
Yeah, definitely. But I think it's just a sense, right? You start to look at it, and we go in with a very cynical mind, because the investor and the founder need to have a long-term relationship, and we are those awkward people for a few weeks that look at it in the most critical way in both directions, and try and pull it apart. And that's why we were saying right at the beginning, it's so much around confidence. And if you put some number in that just is pie in the sky, we're going to start digging into that and go, well, that does not make sense. And then we'll start to go through, which is why it's all around that balanced presentation, really.
Cool. And I think that, it's worth taking away that the same is true across all sorts of things, like your EBITDA margins and gross margins. If they're within sort of outside of what is expected in your sector, there's going to be further focus put on to how do you believe you're going to deliver that? What are the internal efficiencies that mean you can get a better margin than businesses like yours in other sectors or competitors of yours, I guess. So all of these things come with if they're outside of what's considered normal, that sort of raises a red flag, right? And that's where you're going to start digging into those things.
Yeah, absolutely. Yeah. And so obviously you might have an outlier that does do that, but we need evidence. So, sorry, James.
Yeah. So Julia's asked, if you were to prioritize, what would be the top 3 factors, I'm guessing, for founders to make sure they've absolutely nailed?
So I definitely would say the top one is understand what good looks like, which is why I'm trying to mobilize this message. And it's a combination of really boring things that are so important in the long term. So, journaling might sound like a woo-woo thing to do, but the best teams that come to us when I look at everything they've presented, not only have they got everything in place, but they've just got a very, very clear narrative. So first, be aware of what good looks like. That is one of the assets that I have at the end. It's like a 62-page workbook on what to do. And it's all the different documents, what they should look like, etc. And then from there, make sure that your narrative is clear. So it's only 2 factors, Julia, but they're the 2.
Cool. And Michelle has said from a due diligence perspective, what are the roles that should be fulfilled by the founders and team members versus the advisory board and maybe existing shareholders? Is there a clear definition as to what you're looking for?
It's a really good question. Michelle, is there any context to that? Or
yeah, Michelle, are you there?
I am here. Yes, sorry, I haven't got my camera on because I was actually watching the majority of this whilst I was at the gym, turning myself into a tomato. So there's no way whatsoever any of you wanted to see that. Yeah, basically the reason I was asking is because I'm in the process of pivoting from one particular entrepreneurial direction that was nutrition, food and beverage based to a tech direction. Now there's a reason for that, because the food and beverage nutrition side was going to require in-house manufacture, and I'm in the process of moving to London and trying to coordinate finding a site for that, and in conjunction with me, which is just causing me and goes beyond a nightmare in stress, to be honest with you. And being somebody from outside London, I've spent the last 18 months frequently travelling to London, and every time I come home from London, and with the stress of traversing the underground and everything else, I've gone, I wish there was this. And it's been something that's been banging me on the head. And I'm not a tech person. I come from a science background. So this new venture is potentially going to take me into territory that I was avidly against, which is having a co-founder, because I was very much intending to be a solo founder. But I know very well that if I go in a tech app type route, then obviously I'm a tech person, so I'm going to need a tech co-founder. That goes without saying. And that was what led me to ask that question, because obviously, having spent a lot of time in arenas like Bread and Jam, and in arenas that were very sort of manufacturing, food and beverage, nutrition based, I'm now going to take a baptism of fire into the world of tech. Now, I used to work for IBM a very long time ago in another life, so I'm not entirely, tech phobic, very tech acclimatized, but not from a founder perspective. So I've been to lots of board and talks and listened to things about advisory boards. And as I said, I just wondered what your viewpoint was, because obviously as new ventures starting out, I've been to lots of events, lots of Basilis events, where I've seen a founder's pitch. And it might be a co-founder, 2 co-founders, and then they tend to look at fractional people or advisory board members.
What are your thoughts, Hutton? Any advice for Michelle there?
Yeah, I mean, to be honest, first of all, there's a lot of people like you, so I wouldn't be worried around the tech piece. What we're much more interested in is your knowledge of an industry, and your ability to create value from that industry by helping others. So one of the things I didn't show on the beginning of that process, the first thing we do is we throw a hacker onto the whole business, and he will not hack the business, but he'll look at the entire thing, and we'll look at the profiles of everyone in there, and we'll get a sense of who they are and what they've been doing, and just report that back, right? An investor may not care that you move from bread and jam to jeans, or whatever it's going to be. Do you know what I mean? But but what we will always do is just make sure that the senior leadership team and their advisors link up. Okay.
Right.
So, but we won't care whether you haven't got a tech background. So
the co-founder thing is an interesting point, because there's obviously a lot of investors say they invest in co-founders. What they really mean, they're starting to use the language more of we invest in teams, and that includes your advisors, because they're well aware that actually data suggests sole founding teams are more successful than long-term than co-founding teams, because there's less fallout, there's more single-minded direction. So a co-founder is like a marriage, and it can end in divorce if you take it too quick, and don't have the right dynamic between you. So I think there's been a mistake in the past to kind of force founders down a co-founding route for the sake of investment, because of this idea that you get two people for the price of one, and there's twice as much resource to be put into the business, and that can actually end up in a negative sense later down the line because of a falling out or a change in direction. So be careful before you take that plunge. I think from a founding start, you would be looking for, if you're not technical, you would hopefully have deep, or you need to get deep industry insights into your sector. We've got an article on it and on the Robot Mascot website about the 4 types of advisors you need. So if you just Google Robot Mascot 4 types of advisors you need, it should come up. There's basically 4 different categories of advisor, and that could be your team. That could be a co-founding team of 4 people, or it could be a sole founder with 4 advisors in these 4 areas to advise and guide them. But I think if you have a team based around those 4 principles, whether that be a strategic advisor on a small amount of equity, and then you can bring in contracting resource to deliver, or whether that's a co-founding team of people who can provide that insight, either way, you're going to be in a really strong position to present a fully formed team to the investors, whether that's co-founding or not. But essentially, you need to have those 4 things covered, which I won't talk about now because we haven't got the time. But if you look at it, and then hopefully that'll help, Michelle.
Thank you, James. I really appreciate that. I'm actually quite fortunate. I'm based in Oxford, so there are a couple of quite significant AI people based at Side that have already given me advice on that. So thank you. I will go and look that up.
Thank you. Awesome. So we've gone a bit over. Are we okay, Hutton, for time? Or yeah. Okay. It would be good to get these last few questions out. So Julia just answered your question. Awesome. Just headcount is not necessarily an indicator of efficiency, plus certain activities can be planned to be outsourced. Yeah, it's not a perfect metric, right? But it's often looked at kind of full-time equivalent. So you could always look at your consultants are providing the equivalent of X days a month, so the equivalent of a part-time member or something like that. But it'd be kind of full-time equivalents is what it's really looking at. But it's more to say that do some benchmarking around your industry. It's like the Amazon eBay thing, right? It's a great example, I think, because they're both e-commerce platforms, but one, like Amazon, people are quite surprised to learn that they only do 350K revenue for every member of staff they employ. But they have people driving trucks everywhere. They have people sorting in warehouses. That takes a lot of staff, and they're trying to replace those with robots as much as they can, but they can only go so quick. Whereas when you look at eBay and they get 800K revenue for every member of staff they have, and you think about it, it's, well, actually, eBay is literally just a connecting platform. They don't have a warehouse of products. They have people the users post the products to the other users. So they don't have all of that operational cost in the same way Amazon does. So they have they can talk about a strategic benefit to their platform around why they can achieve something beyond what Amazon can achieve in terms of that particular metric. We had another client that was looking at kind of efficiencies in their revenue model, was showing kind of huge EBITDA margins, which were in like way outside what would be expected from the industry. But they had a co-founding team of people that had delivered significant efficiency savings in multi-million-pound businesses doing something similar in a similar field to what they're in, through automation and the creating of bespoke machinery inside these manufacturing processes. And they could leverage that experience to say, this is why we're taking everything that we weren't allowed to do because of internal kind of dogfights in these big corporates, and we're applying it to this startup because we know how we can create these efficiencies, and that's how we're going to deliver industry-leading margins for something that most people wouldn't be able to achieve. That becomes a huge value. But if you just presented, we're going to get twice the EBITDA margin as any other type of company, it normally looks like you just haven't considered your costs properly, and you don't really understand how much it's going to take to scale a business like yours. But if you've got the strategic background to it, all of these metrics start to tell a story. And if they're told in the right way, they tell the story of you being a powerful force to be reckoned with that the investors should be backing, right? I don't know if you agree with any of that.
James, I mean, we haven't met, but this all sounds like music to my ears, obviously, because I do work in the CFO and help businesses space and help businesses to really plan things effectively. So I think what you're saying, as long as it is very clear and the founders analyze what drives activity of this or that, and ideally you should be more efficient going forward, right? As long as the assumptions are very transparent behind the headcount and not headcount, would you agree with that?
Yeah,
James
as long as there's a good rationale and an evidenced rationale behind it, I think people like Hutton who are then questioning that as a red flag will hopefully walk away satisfied that this is possible and achievable with this particular concept in this particular field with this particular team. There's no reason to disbelieve that is actually possible, even though we thought initially that might be kind of an oversight from their part. So is that kind of right, Hutton?
Yeah, I mean, I was about to say that it is surprising how many get through the 6 months of courting or year or whatever it is, and we don't come in towards the end, right? So you've been chatting away, getting all those people involved, and they go right to the end, and we come in and we look at the financial model and go, hang on, that doesn't make sense. All right. And then we'll go and have a meeting. And then I remember one from last year, one of the best companies we've ever seen. And we're like, but we're looking at these numbers, they don't make any sense. And the founder's like, and like, so he was a little bit quiet. He didn't know what to do with it. And we didn't put him on the spot in front of the investor. But what was interesting is he got past every single gate, and then it didn't make any financial sense anyway. So it's just checks and balances, I guess, is your world, isn't it? And for us, it's that happens more than it should, if I'm honest.
Yeah, absolutely.
Yeah, it's really interesting insight. Yeah, Hutton.
I mean, just another quick example. We've got a client that we're working with right now that is leveraging this kind of scalable. It's a product-based business that you'd buy in a supermarket type thing, but they've got a unique business model that means it's much more scalable than your typical product, and that's their leading thing. It's like, yeah, we've got some USPs on the product, but the key driver here, why this is investable, is our unique kind of approach to the business model that makes it much more scalable. Yet the CFO, because they've decided to just work with us on the pitch, and they have a CFO working with them. The CFO has just modeled the business, and it looks like just any ordinary business that would manufacture a product and supply it to Tesco's to be stocked on a shelf. There is no execution in the financials that tell the same story as what the founder wants to be telling investors, which is this highly scalable kind of attractive business model. That the forecast just your standard kind of retail wholesale type model, and the two stories don't align. And
that's a really interesting example, James. What would it be an example of misalignment in the leadership team as well, right? Because that's kind of
exactly. So this is all like, these are now, because they're working with us, we're kind of that safe space where we're talking to them saying something needs to either the pitch needs to change and you need to drop this idea of it being of this positioning completely, or your CFO needs to rework these financials, because at some point that's going to come up as soon as you get the good pitch, and then as soon as you get into that next step, someone's going to point that out, and it's pretty obvious from just sharing some of the key data from the financials in the pitch that hasn't been properly considered in the forecast. So it's a big red flag for us. It's probably going to be an even bigger red flag for someone like Hutton. So it's important to get this stuff right, so you're telling the same story at every step of this process. Because investors hate nothing more than getting pitched something that they're really excited by, and then they're sent all the details afterwards, and all of the due diligence pack feels like it's telling a completely different story about a completely different business. And
that's fascinating. It's almost like unbelievable to hear, but yeah, definitely financials should
happens all the time.
Story, right?
It's unfortunate when it does, but that's what people like us are here for, right? To make sure those things don't. We're in the room with investors. They happen with us, and that's great because we can fix it, and then you can and secure the funding and not have that kind of trouble in the den, as it were. Cool. So I think we're probably going to call it a day. There's a few more questions. I think
I can do very quick answers on those. So
yeah,
the most important thing for the first pre-sealed angel investor deal, it's going to sound weird, but just internal confidence, and you only get that from doing the work. So you would know that process. Like if you've got a great financial model or your pitch deck's great and all those things, that is your number one thing, is your internal confidence. And I know that sounds very vague, but I meet a lot of people who just are not prepared, you know,
I tell
and
you
that's
what, Hutton, that's music to my ears, because that's pretty much 90% of the feedback we get is I feel more confident to go out and just own it and hold up to scrutiny. And it's just that mindset shift is so powerful at that early stage.
Yeah. And there was a question on the Wayne's question. I have built a platform. I'm going to talk to the Robot Mascot guys, because we don't make money from founders. We're more interested in making money from investors, but I put everything into a platform so you can do it yourself. Because our pricing, it doesn't work with founders, basically, if I'm honest, but I do want to share everything that we've learned. So I will share one quick thing and then I'll shut up, which is on that deck. And I can share the deck with everyone. That if you go to our website, you'll see there's 6 quite heavy duty assets on here. So everything that you've done today, and thank you for participating, is a very high level. Where are you? What are you doing? And then the next layers down are literally this thing here. I'm quite proud of this one, 62-page booklet of everything you need to do yourself. You should be able to prepare yourself. And this is for diligence, right? So it's not investment ready, you're already there. And there's another one here, it's a bit lighter, the exit readiness one, but I would definitely recognize that. And if you're merging companies, I've got a guide there on that as well. So yeah, so you can see they're quite related, but it's that top left one. Make it investor ready. It should be diligence ready, but no one really recognizes that.
Awesome. Brilliant. Thanks so much, Hutton. You'll get, I think you'll be able to send information to everyone that's been on the call. So yeah, if you want to share your slides with people, we'll give you the details so you can do that. And yeah, we're super thrilled to have had you here. It's been really insightful, and I think it's really good to see how the next step, really helps reinforce what we teach and what we preach at Robot Mascot, and how that then sort of follows through into the deep due diligence stuff that you're focusing on. So really useful insights, really helpful for those of you that enjoy these events and attend these events regularly. We have another one in about a month's time where we'll be looking at we've got The Journey joining us, who are going to talk to you about how you turn your story and your content into cash, and how you can monetize that. So really looking forward to that one, because we know so much is how you sell through storytelling, and that's what we're going to be talking about next time. So it's all about sales and marketing next time. So I think you'll really enjoy that one. So I hope you join us. We'll be promoting that in the next couple of weeks. So looking out in your inboxes for that one. But in the meantime, thank you ever so much, Hutton, for being with us. It's been super insightful, and thank you everyone for joining us, and have a good rest of the week. See you all soon. Cheers. Bye. Bye.
Take care, guys.